are people finding out about all of these opportunities? Were you getting on the call? Were you meeting with people in person? What did that look like?
Well, I think back in the day, I always joke that it was like a secret society. You know, when I first got introduced to it, it was mind blowing. I was like, what do you mean? People with money that want to invest outside of the stock market lend these other people money, and these people are in buying investment property? Like, I just had no idea. And it's funny, I started as a loan processor and got very quickly bored with that. Then I went down, I learned escrow, I learned how to close loans, how to service loans. I kind of did a little bit of everything. And then I decided I was going to get my securities license because I really liked working with the investors. So I got my license, and because we sold what was called fractional interest in notes. So for example, if I had a $50,000 lien, I could sell that to 5 different guys and they would all partner on it. And what I found was everybody I worked with was friends and family. Hey, I'm George's neighbor. And I had one guy tell me one time, hey, my neighbor invests with you. And I was checking his mail. He was out of town. I want in on this. What's this guy doing?
Oh my gosh, that's amazing. That mailbox.
The funny thing is, they don't like referring people because they didn't want to share. They said, well, you know, I don't want to tell anybody else about this. And then what if you don't have enough deals for me? And so it's, you know, it's still kind of like that today. I think back in the day, I sold notes. So I would have a borrower that wanted to borrow money. We would underwrite the deal, put the whole package together, and then I would dial for dollars. I'd call my list of people. Hey, I got a deal. Do you want to fund it? That's how we just basically were partnering people. About 10 years ago, when I came on board here at Secured Investment Corp, that's what we did. It's so clunky, right? You've got a borrower that's anxious to close with an expiration on a purchase and sale. I'm trying to coordinate an investor getting his money in from an IRA, which is no easy feat. And so what we did was we actually started exploring opening real estate funds where we would raise capital, you know, so for our really passive people that didn't really want the risk of buying a note, well, what if they don't pay? What am I going to do? The funds were a nice alternative because it's the same asset, but now we manage it for them. That way, providing the deal met the credit box and, you know, got our seal of approval for underwriting, we could close it quick and then we could still shop it. And so the funds, we just kind of evolved into a fund management company also. I mean, we have very different investors, right? You guys probably deal with this. We have very active people that are very hands-on, and then we have very passive people that, you know, hey, I've owned real estate, I've owned rentals, I've fix and flip. I don't want to deal with that. I want to travel, and I want you to send me my earnings every quarter. So that's where the funds really are a nice option. We even have a real estate fund that non-accredited investors can invest in with as little as $1,000. So we really can service just about anybody. But I think that's to your original question. Back in the day, it just was really hands-on. There were a lot of working parts. Now with the funds, you know, and the fact that we close them and investors don't feel like it's as urgent, they can shop it, they can do their due diligence. I feel like it's a little bit more passive process now. Same assets that they're investing in, but just the timeline has changed a lot too.
Can you talk to us about what performing versus non-performing notes might mean?
Yeah, I get a lot of that. So performing is a note that is making their payments and is current. And, you know, I think non-performing comes more into play with owner occupied. There is some great strategies to buy what's called a non-performing note. And it typically means it's a note that is behind on payments, is in some form of default. And the opportunity with buying that type of paper is a discount, right? So you've got people coming in buying non-performing notes at 70 cents on the dollar, you know, so they have huge equity going into it. Typically, the strategy that I'm familiar with is they're going to go in, try to get the note performing again, and then resell it. Or, you know, there's also strategies where they'll foreclose, but non-performing is not paying. And a performing note, which is what we sell, is a note that's actually making their payments, is current. But both have great strategies. It just really depends on the risk level of the investor, quite honestly. Non-performing, you're going to have cash flow, right? You know, our borrowers make payments every month. So for my investors that really are focused on cash flow, non-performing is nice. Where in my opinion, performing is nice for cash flow. Non-performing is your longer term investment plays, right? If you're buying at 70 cents on the dollar, you've got 30% equity in it. There's huge upside to that, but it just takes longer to realize your yields on that type of a strategy.